conversation with the pioneer of technical analysis in India, only on ET Now.
Hello and welcome to Talking Technicals. Today we delve into the mathematical world of Fibonacci series and see what important clues they give us for technical analysis. And as always, we have our show expert, Dr. Narayan, who will show us how all the pieces of the puzzle fit together. All right, first off, let's take a quick look at a set of numbers and see what they tell us. There you can see it on your screens. And as you see these numbers, they go 0, 1, 1, 2, 3, 5, 8. And it's interesting to note that any number in this series, barring the first two, can be arrived at by the sum of the preceding two numbers. So this is a series where you have two numbers. When they add up, they give you the next number. And this was actually a very important series brought to light by an Italian mathematician and way back in the 12th century. And this has been used extensively in many fields, including astronomy, architecture, and of course for us right here in technical analysis. They really help us to detect key price levels. So let's take a look at the series once again, and now you'll notice a very interesting characteristic of the series, which is that if you take any number in this series and if you divide it by the next highest number in that series, you will always get a ratio of 0.618. So that's 61.8%, and that's a number I'm sure you've heard being spoken about a lot on our channel. It's called the golden mean. We'll talk about it a little bit more. There are some other ratios which are also very important. So if you take any number in this series and you divide it by a number 2 up from it, you will get a ratio of 0.382, or that's 38.2%. And similarly, you also get the ratio of 0.236 or 23.6% when you divide the number, any number, by the third number that comes after it. So these are the three important Fibonacci ratios. There's one other number that we'd like to add into it, and that's the 50% ratio. And 50% really, as you will see when we show it on the graphs, is a very intuitive number because it essentially talks about half of the value, and that's something that's really very important when we look at technical analysis. All right, so let's come to the first of these ratios. That's 61.8%. It's, as I told you, also called the golden mean, and it's the most often pinpointed number on a price chart. And it's the point where you expect to see a trend reversal or a retracement of sorts. So let's look at it once again on the chart, just to reiterate what these numbers mean, how the retracement points mean. So let's look at a stock, for instance, which say moves up from 10 rupees all the way up to 110 rupees. So that's a move up of 100 rupees. Now, if you're looking at that 61.8% retracement for this stock, essentially it means a move going down by about 61.8 rupees. So if you're at a level of 110, you subtract 61.8 from that and you arrive at a price point of 48.2. That's the 61.8% retracement level. Similarly, if you're looking at the 38.2% retracement level, you come to a price point of 86.4. So you can see all of these on the graph, and these are essentially bullish reversal patterns. That's enough of talk for now, Doc. Let's just see it on the charts.
All right, that was certainly a very, very elaborate introduction to the fib ratios and fib numbers, as it were. Now, the interesting thing is that this has been applied very extensively to the markets, and they have some amazingly accurate kind of predictions which they offer. So I think the usage of it has kept increasing year by year by year, and it's one of the most widely used of methods. Like I will show you on a chart of ACC here, which I have overlaid the fib retracement here. And I have chosen what we call as a reference swing, right? You need to have a reference swing, which is what? One bottom and top, between which you have a moment. That's called a reference swing. So you apply all these ratios which you spoke about, 61 and then 38 and 50, etc., to the length of the reference swing. So the reference swing is retraced on the first wave down, and it comes exactly as you notice here to the 50% retracement. Then you have a nice rally up from there. And in the next fall down, it comes down exactly to the 0.618 retracement. This is ACC as it traded in the market, very widely traded stock, no manipulation here. This is how it works beautifully on time after time after time.
Isn't it weird? 61.8% and it works time after time after time.
Absolutely. You can bet your last buck on it.
Okay.
Yeah.
Well, reversal patterns, and that's what we've been talking about. We spoke about how these work in a bullish move. They also work when you have a bearish move. And here, essentially, a stock goes down. The downward move is halted by a temporary reversal upwards. And once it again reaches those Fibonacci magic numbers, it starts its trend downwards again. Let's see it on the chart stock.
Well, on the downside, it will work in exactly the same way, except it's sort of reverse. I have a chart of Punjab National Bank on for you. Here is our reference swing, and this is where the top and the bottom is. And then if we measure the retracements and put them on, the first swing up comes up exactly to the 38.2%. Then it has a small, let's see, a reaction here. And on its way up, it retraces back exactly to the 62%, 61.8%. And then from there, the decline resumes once again. So whether it's up or down, 38, 50, 62 will keep working.
Right. Okay, well, we have a whole lot more in terms of shallow retracements and also medium to deep retracements, but we'll talk about that after a break.